Hey everyone, welcome to the Hitchhiker's Way podcast. Today our guest is Rohit Mittal. He founded Stilt, a company which provides financial and immigration related services to immigrants. It's actually built by an immigrant. Rohit is actually an immigrant who moved to the Bay Area, and now currently Rohit has sold the company and is working as an advisor and investor to fintech startups. I think I should mention his blog. It's amazing. And everyone who's building a fintech company, who's probably into credit and lending, should go through his blog. And welcome to the podcast, Rohit. So, how's everything going?
Yeah, thank you for having me here, and thanks for kind words on the blog. These are just some ramblings every now and then that I put on online. Things are going well. I've been sort of out and about for the past few months after the acquisition and after leaving my acquiring company. Just been exploring, tinkering with AI. I would be amiss if I don't do that, and it's helping advise and companies in fintech and non-fintech verticals, and yeah, just spending time with founders trying to figure out what's next for me, and at the same time I'm traveling a little bit.
So, are you thinking about building another company with AI right now?
Yeah, it depends on the day that you ask me. So as of now, I right now I'm in the Bay Area this week. So as I've been talking to founders, I've been thinking about building the company, and I realize if I spend more than a day in SF, then I come
You are
out of
going to be
SF
building one.
to build a company. So it's just about the day and who I'm talking to. The Bay Area is definitely energizing in terms of wanting to make you build a company.
Amazing things happen at Silicon Valley.
Yeah, yeah.
So, So I just want to go back to your origin story. How was your childhood, and how did it actually affect your life, as in like work ethic? Like, did
Yeah, I mean, I would guess so. Like my childhood just spent working. Like I come from a family where my dad owned a small deli store. It's similar to a bodega in the US. And people talk about 996. It was like 10, 10, 7. So it was open every day from like 9 or 10 a.m. until 10 in the night, 7 days a week. There are no holidays, there are no vacations, and you're just someone has to be at the store. So I'd been, for years helped my dad since I could, or since the store was started. And then, I would come back from school and I would go to the store. Like it didn't matter if we had exams or if I had to work on something else. So I didn't stop going to the store until I actually moved out of India. And working in that environment, the only thing is working hard, because you are kind of just working every day to make ends meet. And that's what I had been doing. So I'd never, like coming to the US when I had Saturdays and Sundays off, like that was kind of a vacation for me. Because when I was in school, Saturdays and Sundays were spent at the store, and not, the weekdays were also spent at the store in the evenings. But yeah, so that's how most of my, I guess, like childhood that I remember was spent. And then once I moved to the US, I also lived in Germany and London for a little bit, but most of my time outside the India I spent in the US. And I just feel like, I could be working more as I'm trying to build companies or trying to do new stuff. And that childhood is what has shaped me to be where I am today.
that's amazing. You moved to the US, and when did you start to code? Like, did you start to code and you worked in tech companies after you moved to the US? How did that happen?
Yeah, so I'm actually not a software. I didn't do computer science. I'm a very mediocre self-taught full stack software developer. So I can code stuff, but the code is not pretty, and the MVP is just only MVP will work. Like my code won't scale. But I moved to the US to for my master's at Columbia in operations research, and I also studied for CFA levels and did some finance work. And my goal was to work on Wall Street at a hedge fund. And around the time I had moved, like the economy was still reeling from the financial crisis, and I needed a visa for jobs, and hedge funds are not great at that. So I actually spent a lot of time then working in credit risk. That was my first job outside after Columbia. And during that job I learned some programming, I would say. And all of this was learning on my own. There wasn't anything prescribed in the courses or curriculum for us to learn programming, but I knew that for me to build something, I would need to learn programming. The funny thing was, like, all my roommates were also computer science students. So I was the only non-computer science major student in the group. And that also, I think, through osmosis, I learned a little bit about programming, and then eventually I taught myself. So my US move was primarily for master's, studying operations research at Columbia, and then hopefully working in finance.
You told that you were working on finance for a while, and you were in the you were in the fintech space before. Did you build a company before, like before Stilt, and it didn't work out, or was there any startup before Stilt?
Yeah, I don't know. It was in 2007. I tried to do something, and I registered a company. I wouldn't call it a startup or me starting a company, because I was like very young and didn't even know what startups or these companies mean. But I registered a company to teach students in the U.S. online. So the common thing that you see is like Indian teachers in India maybe teaching students online in the US for like AP classes and stuff like that. So I did grade 8 through 12, physics, chemistry, math. And I tried to recruit teachers to teach kids here. I tried to, tutor them, so on and so forth. And I got to learn about this US regulation called No Child Left Behind policy back in 2007, 2008. And government was actually paying for tutoring of students after school for schools that didn't have high enough pass percentage amongst the class. And to improve their standards, government was willing to pay anyone who's going to tutor, just that the student has to agree to be tutored post school. So I kind of tried to tutor some students through that, and I got like some sort of contract with someone and tutored a few students for a little while, and then kind of shut it down. But at the end of the day, it was my first brush up with the quote unquote the starting a company world. And having said that, like, I've always done small business because my family ran, as I said, a deli store. So that itself was kind of a business, not a startup though, but a small business. So I've been around small businesses and done a very small high school startup kind of thing in the past.
So what was the motivation behind Stilt? I know it's the pain that you went through. Can you explain what happened when you moved to the US and you had to go through all of this immigrants legal stuff, and what pain point actually pushed you to build something like Stilt?
Yeah. So when I moved to the US, as I said, I also lived in Germany for a little bit. I was in London for a little bit, and then when I moved to the US, in all three places, I always had challenges finding an apartment to rent. Like, I always had challenges like finding someone who's going to rent me either a room or a place where I could stay. And in the US, it was amplified a little bit because, like, I had support from some organizations in Germany and the UK in London, but I didn't have any support here in the US. So when I came here, I was sleeping on some Columbia alums couch for a few weeks, and as uh, trying to find an apartment, like spending a lot of time applying for apartments, and everyone wanted a credit score or a credit history, or they wanted 40 times monthly rent as income, and I had none of those things. So I was furiously trying to find an apartment, and eventually I found one person, one group of Columbia students, all computer science students, who had like one place in their apartment because one of their roommates had left. So luckily, I found that. But those few weeks of experience just told me that, or showed me that it's difficult to access like products that are dependent on credit score or credit history. And I didn't think too much of it then, because I thought like maybe this is how things work in the US. But when I after I found the apartment, when I was working in my first job, I realized like how banks think about credit risk, and all the credit, everything related to access to credit starts with a credit score. but to get that you have to have some credit score, and then it's like a catch 22 situation. So those things stayed with me. And when I moved to the Bay Area, I was working at a company called Pop Sugar. My co-founder, who became my co-founder, was my roommate from Colombia. He had also moved to the Bay Area, working at Amazon, and we started working on some side projects. And one of the side projects we worked on was building a new type of risk model to help immigrants get access to financial services. And initially, it was just supposed to be a model, a credit risk model that other people would rely on to give access to credit. But we realized we were working full-time jobs, like there was no way we could sell this to other companies, so we started lending money on our own. Then we applied to Y Combinator, so on and so forth, and the rest of the story is just like continues from there. But the genesis of the company was rooted in our experiences, particularly my experience of finding it very difficult to rent an apartment in the US once I moved here as a student.
That is so much of a struggle right there. Like going back to Stilt, before applying to Y Combinator, did you get customers or did it happen after YC?
No, we
Or
had
like,
customers prior to YC. When we applied to YC, kind of showed that we are just going to continue building the company, and we were getting more customers every month. And I was very naive. I didn't even, again, like didn't know much about startups, didn't know much about how to write my YC application. So we shared what we actually knew in our YC application. Uh, and my thinking in like building a business, not as a startup, just building a business, is you just continue to get more customers, because that's what your small business mentality is like. If we have customers, we could continue to make money. And that's what we tried to do. And then I think YC liked that we were just building a company even prior to getting to YC, and was not dependent on YC to get the funding.
that's amazing. So how did you get your first sort of 20 to 30 customers? Like, did you find some insight that drove customers to you while the
Yeah,
interviewing
so
application?
to find our early customers, like my co-founder and I did whatever we could. One of the things we did was we actually went to university. So even before we went to YC, we participated in a startup weekend competition. That's where we built the kind of the product, or like gave shape to the product, and eventually kind of won that competition. And as a part of that, we got to talk to a few people. There were international students at the university. There were other folks. So we started just talking to students within the university, around the university, to ask them if they needed access to money. And obviously people did. And that kind of formed the basis of how we got our first few customers. So after the startup competition, as we were just continuing to build the company, my co-founder would like review resumes for folks, that he would go to like international student associations events to talk to students, so on and so forth. And that's how we continued to find some students who needed money, and we did our underwriting and gave them loans.
So, yeah. So you applied to YC, and just want to know if how many times did you get in the first time, or did you like go through sort of rejections before and you got in?
Yeah, fortunately or unfortunately, we got in the first time. So
Oh,
I yeah
that's new.
so we yeah, it was a story in its own. I didn't expect that we'll get into YC. Even when we had YC interview, I was planning to go back to India, because I thought we would not get an interview for YC even after we submitted the application. So I had already booked my ticket to India, and then I had to change that ticket after we got the interview. And then I decided to still fly the same day that YC was interviewing us, and I had to get to the airport on time. So YC does generally one 10-minute interview. They did it twice for us in the same day. And I was like, oh, my flight is, I'll miss my flight. I got to get to the airport. Can you do it faster? So like we had to go through all of those things. But yeah, eventually after two 10-minute interviews, we got into YC, and then, yeah, continued to build the company.
Why do you think you got in the first time? Like you told me that they were impressed that you were building a company and didn't rely on funding before, and I think that's one key point. Do you have any other key points that YC has looked into you and they were like, okay, we have to fund this person?
Yeah, I can only conjecture because YC knows, like who they take, like they know the criteria. I don't know it that well, but what have seen after like talking to a lot of founders, with mock interviews and stuff like that. The first thing was I think we were very naive, so we told YC what we actually knew. We didn't try to make it sound bigger. We didn't try to puff it up. We didn't try to make the market look bigger or execution looked bigger than what it was. We just shared what we actually did and what we actually believed. And I think that 90%, or if not 90, at least 70 to 75% of YC interview is about what you've already done and how well do you know the problem, how well do you know the market, how committed you are to building this company, stuff like that. And all those things cannot be completed or cannot be generated during the YC interview. Like if you haven't done the work, it's difficult to answer questions that will convince YC to take you. So my my recommendation or my advice to founders has always been just know your stuff really well and actually try to solve the problem rather than work on a product that's hot in the current market, because YC has to look like 10 years out from now, not just like the current version of the product or the current product. And anyways, 40 to 60% of the founders end up pivoting after going to YC. So uh, they the founder should just really know their stuff well and should really try to build a company. And I think that increases, in my mind, that increases the chance of getting into YC.
So, with in your case, can is it okay if I ask the financials that you had before YC, like the traction you showed to
Yeah.
them? So, how much
uh,
revenue were you making, like at that point?
I don't remember the exact numbers, but what I do know was we had like given loans from our own savings. And at that time, it was like, I think between my co-founder and I, and asking a couple of friends, we had pooled together like more than $50,000 worth of loans, and we were charging 10-12% average annualized interest rate. So we had that traction to show. And that, I think, that was at the time when we applied for YC. By the time the interview, because interview was a couple of months later, by the time the interview came around, we had increased that number to, I think, 75 to 100,000. So we continued to just originate loans, asking money from friends. Yeah, that was it. Like we had loan origination numbers as the main metric that we were tracking, and I can't remember the exact revenue at the time.
That's okay. And you got into YC, and what was the biggest learning that you had there? Then you implemented that in your company. Like every company has that, right? Like every one of the biggest companies have like PG saying that you gotta go do this, and you don't have to build this feature now. And was there
Yeah,
any moment for you?
I think there were many moments like those. I think YC was an insane learning experience for us. There were companies that became $20 billion companies that were in the same batch. There were companies, that are building like supersonic planes and stuff like that. There's a wide spectrum of founders working on like insanely difficult problems, and we were just in the business of giving money at the end of the day, right? Like, and I used to actually think that we needed to build more software while being in YC. And one of the conversations with the YC partner, and it was Dalton, mentioned that your product is money. So make sure you have money to give to people, and then you can build the software later. And that kind of gave me some validation and confidence that I don't need to go and constantly just try to focus on software. Like my company's journey is going to be different. And that's one particular thing I remember. The other was just the intensity with which the founders tried to execute. The founders were building their company was something to learn from, and the founders who just continued to execute and continue to build the company, because YC doesn't handhold you too much. uh, yes, there are office hours, and yes, you get feedback and stuff, but at the end of the day, founders have to execute themselves, and there is certain intensity and obsession amongst a group of founders that are just trying to execute as quickly as they can. So Those were some of the things that I remember from YC, amongst many many others. But like a few, if I had to pick a couple, I think those would be my top ones.
Speaking about intensity, you told that you had some great batchmates that has built billion-dollar companies. Like, do you have any story about them, like how intense they were and how obsessed they were? Like, can you remember?
I think the main thing is like all founders who have built companies were just super obsessed with solving a problem, and they may not like, there's a company called Rappi, which I don't know, like I think it's like multi 10 billion dollar plus.
I've heard.
Right? Like it's based in LATAM, and the founders would be constantly flying between like LATAM and come back to like for YC events and so on and so forth. And they were like trying to hire software engineers and stuff like that. In 2016, LATAM wasn't that big. So it was difficult for founders to like continuously to manage YC and build a company in LATAM, but they were so focused on kind of that problem, solving that problem, they just continued to build. So that's one I remember. I also remember Boom. Blake was just constantly just trying to solve one problem after another, and his journey was very different. Obviously, he can't make a plane in 3 months in YC, but he is just trying to like get contracts, and he was trying to convince folks that this is possible. Like I think that was his job, to make sure that people believe that a Concorde type plane is now possible. And he's been, what, 8 plus years, he's still continuing to build that company. So yeah, they're founders. I think I put it on Twitter. I actually met co-founders of OpenAI. So OpenAI, even though it was not a YC company, like they started at the same time. So I met Ilya at one of the YC first YC dinners, or the YC launch dinner, or whatever it was. And he and I were talking about like how to use data and data science to help immigrants get access to credit. So he and I got into like a discussion about like what data can be used. My idea was to just use someone's email to originate loans, and then we kind of just like went into deeper discussion there. And I could tell like I didn't know who he was like really at the time, and obviously he has had insane success since then, but I could tell like he was very passionate about building data science and machine learning models. And we just brainstormed a full problem and a solution during that conversation. And that's the kind of focus, obsession, intensity that I think is one of the common things amongst founders who end up building big companies.
That's really amazing. So you raised funds, but you did debt. You were doing debt financing. So
Hmm.
how does that? You did raise Series A, right? So how do you
Yes.
think first time founders can raise money? Like when they are new and they have a bit of traction and they're just looking for investors.
Yeah, I think the founders just need to show that, depending on the stage of the companies, the founders just need to show that there is a possibility, irrespective of how small it is, but there is a possibility that there is a big company in there. And then founders are the ones who can make it happen. And they will continue to build the company irrespective of whether they get the financing or not. Because if the idea is actually working, it's actually worthwhile building, then they will find the money from somewhere. So I think that's one of the things that I realized, like having that big vision and constantly moving quickly towards it is one of the big things that helps with fundraising, obviously showing traction and growth and like some product market fit, depending on the stage. You kind of prove to investors that things are working, and if this thing works, then we can get to the next point, and at that point like there will be some other problems, we'll solve those, and then just continue to grow the company. And that's how all companies are built. There's the journey broadly stays the same, but the specifics are actually different. So someone building like supersonic planes has to convince investors of technical feasibility. If someone's building, Rappi, they have to show that unit economics is actually feasible and that customers actually want it, so on and so forth. So what they need to prove depends on the company, but at every stage they gotta just de-risk the company as they move forward and as they grow. And then there are investors who are willing to take that bet and support the founders, and in some cases that bet comes true, and that small company actually becomes a Facebook or whatever it may be.
So you raised money, seed money from YC, and did you raise money in the demo day? Like, okay, did you get some angel checks at that day?
Yeah, so YC in 2016 was 125K, uh, and it didn't have the 375K that it does now. So it was only 125K, and that's the money that we raised when we got into YC. And then after we graduated YC, we raised a few. We raised money from angels. We didn't raise a big round right out of YC, but we raised some angel money.
So after that, did you do debt financing or did you go straight to Series A? Like,
After that, we did some debt financing. It was very small. It was $1 million worth of debt financing, and then we did a seed round, and then we did a larger debt financing. That then we did close to $10 million, and so it was like a just for us, it was raising equity and debt. Generally, these two things happened at the same time, or in close. Uh, they were close. Like first, we'll raise the round, the equity round, and then we'll raise debt, or we'll have commitments from the debt investor, and then we'll raise the equity round and then close the debt later. So they were always close to each other, and as the company grew, we just continued to raise equity and debt in conjunction as the company continued to scale.
why did you choose to go to debt financing at that point? Like,
Yeah, for
yeah,
our
after YC.
company, we were Yeah, so for our company, we were a lending company, so we had to lend money. And to lend money, we needed money. Like I can't raise 100 million in equity to lend. That's for the operations of the company. I needed to raise a separate debt facility that will be used to originate loans for our customers, and the debt investors would continue to earn interest, while the equity money will be used for operations like salaries and marketing spend, so on and so forth. But the loans were actually done using the debt facility.
Yeah, that's amazing. So you raised money through debt. Yep. When do you think companies should opt to go? I think you've already answered that question. It was specific for each company. But if a company is deciding to raise in debt financing, what kind of points would you advise the founders to look for? Like, they should be aware of these things.
Yeah, I think the biggest thing in debt fundraise I've mentioned to founders is like, do not try to raise a lot of debt unless you are confident that you have some things figured out. The same is true in the equity market, or similar dynamic is true in the equity market. But debt markets are more data driven rather than more vision driven, because the debt investor, their upside is limited to the interest that they will earn, and their downside is like you just burn all of that money in bad loans, right? In equity, investors are willing to bet on the 100x upside, and the default case is that you actually, the company doesn't work out, or that's the highest probability case. Now, the main thing is, in debt investors, if you have a little bit of data, by and uh, that amount may change depending on the type of your company, but if you have data, it actually becomes way easier to raise a debt facility than without any data. So try to generate some data, be it from equity capital, be it from your own money. Like at Stilt, we, as I mentioned earlier, like we gave loans with our own money. With like, if hypothetically we were doing mortgages, obviously we would not be able to originate mortgages with our own money, right? Because homes are expensive. Now, for that, you'll need to figure out a way to just originate a few loans, or give lend money for a few homes, and then you try to go raise a big facility. You also need to remember that as you raise a bigger facility, the more restrictions you will have, because the bigger lender will not give you a lot of room to try new things, try different things, because they don't want to take a lot of risk. Now, the founders should just have a path of like how they're going to prove to the first debt investor that what they're doing is not going to result in the debt investor losing all of their money. And then after proving that, they need to prove to the next debt investor that if they scale it, it's going to continue to perform the same way as it has performed at smaller scale. So those are some of the things that founders need to keep in mind. And there's always a certain path that every company needs to take to raise debt successfully at terms that doesn't kill the unit economics of the company.
Awesome. So, while building companies and talking to customers, there's this quote from Henry Ford that if I ask my customers what they want before building the car, they would have told that they want faster horse, right? So
Mhm.
the thing I'm pointing here is customers know the end point, but they don't know how to get there. That is
Mhm.
the work of founder to figure it out, right? So for that, they need to stay ahead of their customers. But at the same time, there's a fine line between staying ahead of your customers and losing your customers.
Mhm.
How do you think you have handled that? Like, how would you advise founders on this, the art of staying ahead but not losing them?
Yeah, I think in our case, and like Jeff Bezos also says that you have to invent on behalf of the customers. Like they don't care; they just want the thing to work, and it's your job to um, invent things so that the customer's life is easier. In fintech companies, for fintech companies, generally the product is actually known, as in that our customers knew about lending already. Our customers knew what a loan is. Our customers wanted money. Our our actual customer that we had to convince was the debt investor, were the people who were giving us hundreds of millions of dollars to lend to. So we had to prove to them that our market, which is the immigrant population, excuse me, is not risky if we lend money to them. And for us, like, it was not an innovation in terms of building a new physical product. It was an innovation in terms of credit risk. And that could only be proven with data. The advantage, or like, it was very simple for us that if we could prove with data, i.e., we give loans, they get paid back, we give more loans, they get paid back, we could prove that if we give loans to immigrants, the interest rate that they pay and the default rates make sense for the net return to the debt investors. So in our case, it was way simpler, but in some other cases, like in developing the iPhone or something like that, it becomes insanely more difficult, and that's where you just gotta have your pulse on the current technology and where the technology would go in the next few years, because developing these products takes at least 1 to 2 to 3 years of intense work, and it has to just work because the customers are very quick to just move to the next product if the new product doesn't solve their problem. So for fintech, it's like fairly more straightforward. You got to convince different parties, and operationally it's complex, but it's still not as difficult as thinking of a car from a horse, kind of thing. But for physical products or other software product, it is something like that, and that just takes time, and I think a lot of thinking on the founders to make sure that they have their product play well with existing technology in the market.
That's amazing. So, speaking of the fintech space, I think I read one post from your blog which read, "How can startups take over like banks in the fintech space specifically?" So, can you brief me about that? Like, if a person is building a fintech company, and I think you wrote the blog at 2020, and right now, I think a lot of things has changed. AI is moving at a faster pace now. How would you change your perspective now? Like, what would you add on to those things?
Yeah, I think so. The particular blog you're talking about is about recasting cost structures for fintech companies, or recasting incumbents in the fintech world. And recasting incumbents, in recasting incumbents, the core idea is to take the strength of the incumbent and turn it into a weakness. And technology has to allow you to do that. So for banks, just think of all the advantages the banks have. They have low cost of capital, they have good brand name, they have regulatory capture, so on and so forth. So you need to think, okay, these are all the advantages. How can we turn this into a weakness? Like Lending Club tried it in a certain way. It said, like, we won't take capital from banks, we'll just disintermediate the banks and we'll take capital directly from the normal public or the retail investors. And then it would, like, banks would not be able to keep up with that. And it actually came true. Like, all the personal loans that are originated, I think banks originate only 20% of that. 80% of that, those are originated by the broader market now, or the non-bank market. Now you apply the same to Robinhood. Banks used to charge $7 for commissions, and they had like their slow processes, a bad product, like takes a long time to sign up, so on and so forth. So they took all of that and they made a product that was really fast, that had no, it had zero fee commission. It had zero, the product was good. It was on mobile. At that time, trading mobile apps did not exist. Now it's pretty common. So you take the advantages of the incumbent and then turn those into weaknesses. My broad thinking around these things in fintech is that there are three or four things. One is the acquisition channel. Banks acquire customer a certain way, and they cannot acquire customers through word of mouth or referral or things like that, right? Like, so you can, if you can, like, you should try to acquire customers that way. Second is the business model. In Brex's case, they inverse the business model. Banks are like, they have to mitigate risk. So banks always ask you for personal guarantee when you apply for a business card. Breck said, we are not going to ask you for a personal guarantee. Just show us real time balance in your checking account or in your company's checking account, and we'll give you a credit card based on that. And and we'll issue you a card instantly. Banks still have not caught up with that business model, right? Like, so Brex inverted the business model that banks have. So that's how you can actually build a new company. The third is target market. Banks always have to cater to target market, the full target market. And if you, like, we started with just immigrants, so there is no bank that will come out and say, we only focus on immigrants. It could only be done by a company like ours. And then we build the product, the acquisition, and the risk models for that market. In and and by doing that, we can actually, again, disintermediate the banks or build a separate business, different than the banks. So you just got to think about, like, these types of things in broad context and try to figure out what are the strengths of your incumbent company, and how can you build a product that the incumbent may not be able to follow, because of how they're structured.
All right. So I've also read another thing from your blog that you did around 50 YC mock-up interviews for founders who were trying to get into YC. So did you find something common, like the common mistakes founders make at that point, and how would you go about it if you were going through YC again for the first time?
Yeah, I think as I said, the advantage and disadvantage we had in our YC interview was we were very naive. So we just told YC what we knew. And we were building a business. We told them we are building a business. 75% of what was asked in YC interview, we had already kind of been doing. And we could not have, like, prepared for the interview well enough if were not actually working on the business. So I think of the mock interviews, because, like, many people have gotten in, or many people have become YC founders out of that. And what I see is, like, founders make things complicated to sound smart, or to make their company sound big. And my thinking is that YC partners interview thousands of companies, have interviewed thousands of companies, so they can see through the truth very quickly. And it's better for you as a founder to talk about things that you really know, rather than try to make your company sound big, rather than trying to make yourself sound smart. When you are asked rapid fire questions one after the other about your company, you don't have a lot of time to think. and you'll answer what you actually know. So that's what I've kind of seen is founders who actually know the problem really well, who are honest, who are just answering the question um, based on their experience and what they are building. They have higher chances of getting in compared to the ones that try to hide things, or ones that are trying to make their idea sound big or whatever it may be. Because again, like YC knows, like half of the founders will end up pivoting right after getting into YC, so they are making a bet on the person or on the founders rather than making a bet on any particular idea. So you gotta show YC that you're a good founder to bet on rather than that your idea is big.
So you are also an advisor and an investor. So I heard this from Elad Gill that it's kind of contrarian. It's kind of different from what YC has been doing. Like you told they fund based on founders, but Elad is like he has totally different thesis. He checks the market as well as the founders, the team. Both should be good, and at that time, a magical thing happens because he has this thesis that market always wins, right?
Mhm.
So how do you go about that? Like when you are planning to invest on a company, do you check the market as well as founders, or do you invest solely on the founders alone?
I think, yeah, it just depends on what stage you're investing in and what type of company the founders may build. So, as an example, Brex founders initially got into YC and they were building a virtual reality app. That's
Yeah.
what they wanted to, and they pivoted to Brex with during YC. Now, if YC had not taken them because they didn't believe in the virtual reality market, then there would be no Brex. And I think that's the key thing is like depending on when you're investing in the founder, you make a decision on I expect the founders to figure out the right market to go after, or like if someone has raised seed or series A already, then you also look at the market in addition to the founders. At the very early stages, you just have to look at the founders and you have to trust that the founders will figure out the right market, and they will know, they will see that the product is not working, and they'll pivot accordingly.
So I just want to go back to Stilt. You sold the company. Um,
Mhm.
I think when did you sell the company? Like the year last year?
2020.
Yeah, 2022. You sold the company, and selling a company is also kind of like a process that it's a tough process to go through for founders because it involves a lot of negotiations and a lot of second thinking. So, can you walk me through what should founders hold on to while they're negotiating when they're exiting their company, and what should founders give up on that negotiation? Like, how was your whole process?
I think like I think equity fundraise is a pretty straightforward process. There is like you look at the market, you look at the founder, growth, traction, so on and so forth. But each acquisition is very unique, depending on what, depending on the situation your company is in, depending on why the acquirer is acquiring you, depending on who your investors are, your stage of the company. There, you may want to optimize for different things. Like if you're about to be shut down, it's better to sell the company rather than to shut down, right? To give some exit to the maybe there is some financial exit, or at least like aqua hire job type thing for the team. So founder has to think through all of these various points and then really take have a clear positioning in their mind about their own company and try to make a decision based on that. During the acquisition conversation, one thing I try to tell founders to not take personal liability for anything that may turn out to be negative long term. I've also seen in some cases like investors try to push founders to make incorrect decisions, that basically make decisions that will not impact the fund at all but will also not help the company. So founders kind of also need to manage that. At the end of the day, acquisition is managing a lot of different parties with different incentives: your employees, yourselves, your investors, your acquiring the company that's acquiring you, so on and so forth. And there is no right answer aside from making sure that you try to do the best for, like, there is something that's optimal for all parties. It's may not be like great for you, but it could be okay for investors, it could be okay for the acquiring companies. Try to find that optimal point, and what's important to you. If the company is already, the company is doing really well, the investors may tell you to not sell it, right? And then you got to decide if you feel like you can actually take it to a very large outcome, or like is reasonably good outcome for yourselves is more important, right? Like, so founders has got to think through all of these things, and there's these situations are fairly complicated compared to like equity fundraise or debt fundraise.
That is, acquisitions are kind of hard.
Hmm.
And we spoke about, you mentioned about investors pushing founders to make wrong decisions. I think you would have seen that happening here and there. And do you have an answer for what a good investor should be like from the beginning? They invest in your company and they have been hiring, or what a good investor should do. What's the role of a good investor?
I think that's a tough one, because if there's one definition, then everyone would be a good investor. I think good investor, in my mind, has to actually, investors have a duty to their LPs who they have raised fund from. Just be saying seeing them only from the founder's point of view would be a little selfish. So a they have a fiduciary responsibility to their LPs to find and invest in big, like potentially big outcomes, and to make, for that to happen, they have to invest in founders. They requires a lot of support to founders. It also requires a constant, I'd say, discussion with founders as the company is being built. It's founders don't always make the right decision, so investors, through their experience and network and knowledge, can help the founders get on the right path. In some cases, investors would want to sell the company and the founders would not want to sell the company. So in cases like where a founder has made a decision, I think investors should continue to support the founders. Those are some of the things that I've seen like good investors do. Once they commit to a company, they just help the company however they can. That doesn't mean that they say yes. And again, at the end of the day, I think investor everyone forgets that investors also have a responsibility to their LPs, and they that's the only way this ecosystem can work, if investors deliver good returns to their LPs, and LPs continue to invest in these investors over the long term.
And that's good. So I just want to, like, I have this question, and this is my personal question, and I think a lot of people from India have this question, especially college students. Like, there's a brain drain problem in India that most of the college students move to the US and do their masters and become an immigrant there, and they have to go through a lot of things as an immigrant, right? Let's say let's say this person, a college kid, is moving to the US to build a company. They are moving to the Bay Area for building companies, and that's amazing because Bay Area has a lot of opportunities, right? But at the same time, now they can just build it in India and sell it to the global market in US, right? And then they can go raise funds from maybe the US, and they can get a visa there. So, how do you think about all of this? Like, is moving to the US worth it? Like, going through all of that struggle for the green card, is it all worth it for founders who are building in India?
Like, I think it's a very personal thing for each founder. For me, it was worth it. And as you think about like the type of company you want to build, especially if you have customers in the US, obviously there have been many successful Indian companies that have built in India and sold their product in the US. That model works well, but I think that there is an advantage of being in the US if you're selling in the US market. You can say you can also argue about having an engineering team in India. You can say that the founders don't need to spend 100% of their time in the US. But I think being in the US helps learn the culture. Like if some, US person tries to sell in India, everyone will talk about like you have to understand the nuances and you have to understand
That's
how this all
different.
works, and right, like so the same thing is true in the US. If you have to sell in the US, you have to understand the nuances. Just by saying that you can build in India and sell in the US is not as straightforward of an answer. Now, if you want to be in the US, obviously not everyone is a founder, but particularly for founders, they are newer. uh, There is more support in helping you stay in the US compared to when I started the company. So the O1 visa is better understood. Investors are willing to support. There are a few new international entrepreneur rulings or have come out, some guidance has come out, and all those things are helpful. And the founders just need to decide if they want to build while staying in India or if they want to build while staying in the US, where they want to build the team, where they feel comfortable building the team. And yeah, as customers are in the US, I think it definitely helps being in the US.
That's a really interesting point that you brought before. Like U.S. companies building for India, there's a lot of things that they have to see, and there are very little companies in the U.S. which has kind of built. I mean, especially in consumer side, there are very little U.S. companies that has built good products in India, right? So one of the things that stood out for me in your recent posts was with Onbo, a product that you built and the way you marketed it was through
Hmm.
billboards. Can you walk me through that? Like, what was the whole process and how did you do it? Like,
Sure. So for Onbo, the main thing is like, so Onbo was built out of Stilt. We built a lot of vertically integrated infrastructure to originate loans for immigrants, and which meant that we acquired our own licenses, we built our own risk model, we integrated our own integrated loan management systems, we built raised our own debt facilities, we did our own servicing, so on and so forth. So we had like this full infrastructure to run a lending company. And then with Onbo, we productized Stilt's infrastructure to allow other folks to originate loans. And we had a lot of traction, or we had a lot of proof points with Stilt that the infrastructure worked. So it was not just built out of thin air trying to prove that it works. It actually worked. And then as we built Onbo and as we marketed it, we kind of tried things differently than our competitors or than what was norm in the industry. Our first marketing channel for Onbo was actually billboards rather than paid ads or customer network or whatever it may be. And that worked well for us because we immediately earned trust of the market. We continued to get more validation. And as people saw the billboards and people saw that we were willing to commit resources to this product, that actually helped us sign up new customers faster. So yeah, Onbo had insane product market fit. It grew fairly rapidly soon after we launched it because there were very few other competitor products, and we it was just the banks, and then it became Onbo, and we were seen as the alternative to the banks when we were building that product.
awesome. So while building Stilt and up until this point, do you have any good story like you thought the company was going to die and you thought the company was going to die, but you managed to push through it?
There were many instances like company was dying every it felt like every year the company is going to die, and then we slowly pushed through it. We try to make it
What
work.
was the worst situation?
It's always the worst situation. There were multiple instances where we had less than 2 months of runway, and even during the acquisition, like if the acquisition had not completed, like it could have been not a good outcome. But I don't know, like maybe we would have survived even that, right? Like so every time it felt like this was the last straw and the company may not survive, but we just continue to try and continue to just push forward and take one step after the other. And yeah, things continue to work out. There were times when we didn't have enough money. There were times we didn't have enough debt capital. There were times when we felt like the the market's not there, but if you continue to just push through, many times it's going to work out, and there would be one time when it doesn't, and then that would be the last of the company. But I think most companies, not just still, just go through this type of journey. I've heard other founders who have had like 1 week of runway, and the wire hits the bank and the company is back on its track and then become a big company.
That is always there. Like all of you won't believe me. Like most of the founders that I've spoken to said the same reply. I've
Yeah,
thought about my company dying so many times. Like every day, it's like that.
yeah. That's the thing. It's just like it's not as rosy as it seems on the outside. We just
Yeah.
don't, I think even people, and you have to like shield employees from the volatility of all these things. So the employees, yes, they see it, but they still don't see the full extent of the volatility that the founders go through in running the company.
Do you have any contrarian piece of advice that you believe in a lot and a lot of people don't believe in it in terms of company building?
I think a lot of time during Still's journey, we like actually now I remember, like Onbo was one of those things that people thought wouldn't work, and I just couldn't convince people fast enough to try a different product. My main thing to founders is that like you it's better to be in a very uncertain future than to be a very certain and not big future. What I mean by that is like if it's proven that a certain business model has previously not generated returns, you'll find that your life is incredibly more difficult than if you are in an area where it's not yet known if you can generate large returns. So a lot of like investments are just based on the future uncertainty and future hope. But if it's proven that if you build this business, it's not going to be big, then you won't be able to raise money. So that'll make a more difficult VC path.
Yeah. So the last question I ask this to all of the founders in my podcast: how do you define your life? Is it defined by the work you do? Is what's the definition of life for you?
Hmm. For me, I think it is. I think that's the only thing I've done in the past. As I mentioned, like I was just going to that store every day as I was in India, and I just continue to like think more about work than other things. And I find like the I'm actually I don't need a lot of time to decompress or to travel or whatever it may be. Like even small travel is good for me. So is okay for me, and I feel like, oh, I've just traveled too much. Like if I'm out 1 week, it just feels like, oh, it's already been super long. So yeah, my whatever I do, I think I would like hold work as one of the bigger pieces of how I define my life compared to anything else right now.
I just got a follow-up question for this. Since you speak about working, you think about work all the time, and how do you deal with burnouts, like while building a company? Like,
I always told people, and I always tell myself that I can just close my computer and walk away. And like it's nothing, like no one can stop me from doing that. So whatever I'm doing is my own choice, and there is no one's forcing me to do it. And if I feel burned out, I can just close my computer and walk away. And knowing that I have that freedom is very liberating.
that's amazing. Thanks for doing this. It's been amazing. I think I learned a lot in this podcast,
Yeah,
and it's
thanks for
such a
having
great.
me. Hope it was helpful.